Hey everyone, it's Mike Adams here with the Simple Dollar. And have you ever wondered why savings account rates are so low right now? That is a fantastic question. Now we're gonna break down, the why in today's video. And for more great training just like this, before we kind of get into it, visit us over at thesimpledollar.com. We have a ton of articles and training there for you to help you master your money. Here at thesimpledollar.com, we believe that personal finance doesn't need to be difficult, and we're definitely here to help. So visit us over at thesimpledollar.com. And we did a full-on article as well to complement this video, and I will put a link to that article in the description of this video here. So back to the question at hand, why are banks giving such low rates of return on savings accounts? And I know this will age me a little bit, but I remember back in the day, and we're talking, a good 10, 15 years ago, you were able to put your money in a bank savings account and get a really good rate of return. Saving was actually winning back in the day, and you'd be able to get anywhere from 4 to 6% as far as a rate of return on your money. And so for example, let's say you had $10,000 that you were able to put into your bank savings account, leave it there for a full year at 6%, you would earn about $600 on that $10,000 in the savings. And that's a great rate of return. Divide that over a year, that's about $50 of interest, every single month that you're earning at 6%, which is not that bad, especially in this current economy. I think there's many folks out there that would love to get their hands on 6%, locked in as a very solid rate of return. But nowadays, things are a little bit different. Even on the high yield side, which is, the high yield savings account is a little bit different than a regular bank account. But even with a high yield savings account, the highest we're seeing right now is about 1.5%. And sometimes those are gonna have restrictions, like you need to deposit your money and leave it there for X amount of time, or there's just some restrictions on how you can use that money. But the bottom line is 1.5%, if you had $10,000 deposited, you left it there for a full year, at the end of the year, you'd have $150 worth of interest that you've earned on that 10 grand. And so you divide that over the course of 12 months, you're looking at about $12 or so per month that you're earning in interest, which is quite a bit less than what we've seen over the years. And as a matter of fact, right now, current savings rates are less than inflation. And for those of you guys that don't know, inflation is really just the value of your money going down year after year. And we are typically seeing about a 2.5% rate of inflation. So if you're saving at less than 2.5%, the value of your money year to year is going down. That $10,000 today, based on inflation, that same 10 grand will buy you less next year based on inflation. But here in this video, we're gonna talk about the why. So let's dive into the why all of this is happening. And we'll describe some of the terms and some of the players that are involved in making this ultimate decision on keeping the interest rates on savings so low. Now, one thing to note is that banks do have the ability to pay whatever they want to pay on a bank savings account. If they wanted to, if a bank said, hey, we just want to give 5% on this savings account, they could certainly do that. However, for banks, that would be what we call bad for business, And this boils back to, understanding how banks make money. And they make money primarily by issuing debt or issuing loans, and from there charging somebody interest on that debt. So they make money, obviously there's fees and other things, but interest is how banks make money, charging people interest. And so if a bank is gonna turn around and pay you 5 or 6% rate of return on that money, the bank needs to be able to lend it out and charge somebody quite a bit more, so that way they're able to realize a profit. Whatever they're paying in interest versus what they're charging in interest, that spread, that is the bank's profit. And if you don't know much about banks, know this, they are very serious about their profit. That is what banks exist for, is to make money. So always understand that. And when you look at the rates right now on mortgages and even other types of loans, you're looking at 3-4% as far as what you're seeing, for those that are highly qualified. Some are even getting sub 3%, on their mortgages. So if the bank is only able to charge, let's say 4% on a mortgage, they would lose money. If they were paying out, 5% to utilize or leverage, I should say, some of your funds to lend out to somebody else, if they're paying you 5%, they need to be able to charge somebody more than that in interest. And right now, interest rates are very, very low on mortgages. So that's one of the key factors as to why banks are going to keep that savings account rate low, because they're simply put, if they give you a high rate of return on the savings, they're not going to be able to charge that much in interest on the other side to make their profit. So those that have money in savings are just going to have to deal with a lesser rate of return until that changes. Now again, there is another player in the mix here, and that player is the Federal Reserve, and commonly referred to as the Fed. Maybe you've heard about it, but the Federal Reserve is the United States central bank. Okay, so that's what we call like our lender of last resort. If you've been anywhere around the news lately, you've probably learned quite a bit about the Fed and what they're doing to help grow and stimulate the economy. And that's really the point of the Fed is, their point. Okay, at least on paper, the point is to stimulate and grow the economy. And they have a couple of tools in which they can leverage in order to do so. Now, the number one tool that the Federal Reserve can do to try to stimulate growth is to either raise or lower interest rates, okay? And so when the economy is struggling or there's just not enough economic activity to stimulate job growth, the Federal Reserve is going to lower interest rates. And when the Federal Reserve does this, they are making it cheaper for regular commercial banks to acquire funds from them to then lend out to the public. And so with the Federal Reserve lowers their interest rates, and right now they're almost near zero. So it's costing commercial banks very, very little to get funds from the Federal Reserve and then turn around and lend that out to somebody else at a much higher rate of return. So as of the recording of this video, banks can get money from the Federal Reserve at about 0.75% as far as an expense. So we're talking about less than 1% is what it costs the banks to borrow the funds. Okay, and then they turn around and lend those funds out to somebody else. Again, let's say with the current rates on mortgages around 3.3%, they're able to get the money at 0.75 and then lend it out at 3.3. That spread is what the bank is going to earn in profit. And so again, with the Federal Reserve having rates so low, it doesn't give the banks any incentive to raise what they're paying out in savings accounts. Because again, if they got to pay you 4 to 6% like back in the day to leverage your money to create loans and get it out there, they're technically losing money in comparison to being able to borrow those same funds from the Fed at 0.75%. So that's why you're seeing most savings accounts are well under that 1% rate of return. Again, when we're talking about high yield, you're starting to see some that are 1.25, 1.5% rate of return in a high yield savings. But on a typical bank savings, you're seeing even less than that 0.75%. Because again, it doesn't make sense for the banks to want to get deposits from you and pay more than 0.75% when they can get and leverage those same funds to create new loans from the Federal Reserve at 0.75%. So will this ever change? In short, the answer is yes. Now, when is anybody's guess, but the bottom line is, it's all about incentive. And right now, the banks don't have incentive to pay a high amount of interest on savings accounts because money from the Fed is so much cheaper. So once the Federal Reserve decides to raise the rates back up, that might create more incentive for regular commercial banks to offer more of a rate of return on their savings accounts. So that way people will put the money in there, they can leverage against that to create loans versus getting money from the Fed. Once it makes more sense and cheaper for the commercial banks to get money from people and pay more on the savings, that's when you'll start seeing that savings account rate of return go back up. So in the meantime, what should you do with your savings? And here at the Simple Dollar, we believe that you should definitely have an emergency fund in place. Most folks are going to recommend that you have at least a 6-month reserve. And that's 6 months of all your monthly expenses saved up, either in a savings account, preferably a high yield savings account. And again, if you want to learn more about high yield savings accounts and which banks are offering the highest rates of return, make sure to visit us on thesimpledollar.com. We've actually done a ton of due diligence on some of the best bank accounts that are out there, best savings accounts, best checking accounts that are paying the highest rates of return right now. And so it makes a lot of sense if you're going to utilize a savings account is to get the highest yield you could possibly get. And so get your 6-month reserve, put that into a high yield. But when it comes to everything beyond your emergency fund, should you continue to save that money at 1.5%? Well, you certainly can. However, here at the Simple Dollar, we believe that you should take a look at any existing debts that you have. So let's say you have a car loan and the balance on the car loan is $10,000 and they're charging you 4.99%. Over the course of a year, you're gonna be paying a lot of interest on that loan. In comparison to where if you had that 10 grand in a bank savings account, even high yield, you're gonna earn 1.5% or $150 earned interest versus paying out a lot more on a car loan. So in those types of scenarios, if you have interest-bearing debt, and certainly debt that is charging you more in interest than you're earning if you were to save the money, it makes a lot of sense to tackle and pay down some of those debts. And when you do that, you'll end up with a net savings, okay? The amount of money you would earn in interest versus the amount of money you're actually able to save right now by paying off interest-bearing debt. So hopefully you guys found value in this training and in this discussion. If you did, make sure to give this video a comment and give it a like below. And as well, make sure to subscribe to this YouTube channel. Again, here at the Simple Dollar, we believe that personal finance doesn't need to be difficult, and we're definitely here to help. So we're gonna be putting out a ton of content to help you improve your financial literacy, better your personal finance, and help you master your money. And of course, you can always visit us on our website, thesimpledollar.com. Have a great day, everybody. We'll see you in the next video.